Okay, good morning, guys. Welcome, morning briefing, Thursday 8th of February here on the Amplify training floor in London. Looking forward to the session ahead. We're just going to cover off all the big issues here in the briefing as usual. We've got a big day for the UK because we've got the what's billed as Super Thursday. This happens once a quarter. We get the normal monthly Bank of England monetary policy meeting, but we then also get more being the Bank of England updating their forecasts for growth and inflation, and then also Mark Carney has a press conference, so definitely potentially sensitive here for UK assets. I'll be talking about sterling and what we might expect come midday. Also, obviously, still in that aftermath of the big stock market pullback from earlier in the week, so we'll talk through that. We've had big moves on oil yesterday afternoon as US oil production smashed up through 10 million barrels a day for the first time, well, since 1970, and it's knocking on the door of an all-time ever high for US oil production. And perhaps most interestingly, it is official now, the US is producing more oil than the entire OPEC collective. Actually, now that I've said that, that's not true, but I've got a chart that talks about comparing US to OPEC output, and the US have just taken out OPEC and become the kind of the biggest producer in the world. So this is interesting for future supply and therefore perhaps negative price movements. So we'll talk about that. Other stuff going on with regards to the debt agreement, or I should say the budget agreement in Washington. They seem to maybe have inched a touch closer to getting a deal done. So other factors as well to talk about. So let's hit the charts here and let's talk about the US equity space first, because let's actually, this chart's looking very messy now. It's the problem when you have massive movement. You start drawing lines everywhere, and your chart can often look just a bit of a mess, and it's hard to really see what's going on. So let's just clean it up here. Look, this was the low on early hours of Tuesday morning after the big drop that we had Monday. Of course, we were drifting lower end of last week. We had a 2% sell-off on Friday last week. Let's draw a line in there. That was Friday's low. And we kind of went sideways, then the big collapse. Now on the rebound here, obviously the rebound's been powerful. I've been drawing, looking at some Fibonacci's, and if I go back to that all-time high that we had back start of last week, and we draw this fib in, then the 50%, and let me just zoom back in now, the 50% fib here had done a really good job of capping the upside on the 6th of February going into the close, and then we were kind of flirting with that yesterday and into the kind of European close. In the end, we had that step higher and we pushed on up through the 2700 handle. You know, the Dow leading the way on a positive sort of US cash open. The Nasdaq was less keen on moving forwards and upwards. Held back, so the tech stocks were underperforming a little bit. But actually, by the time we got to the end of the session, so we were looking at an up day again, adding to the rebound from the day before. We were 1.2% up on the day at one point, and just in touching distance of testing this low from Friday's session. But then as we went into the US close, everything just came dropping back down. In the end, we broke through the low and made new lows for the session, actually finished down 0.5%. So weakness into the US close last night, and we're not,
so just heads up,
nothing quite, nothing specific, or it's difficult to pinpoint something specific for the reason for the sell-off. Obviously still people are in that conundrum of trying to decide whether the big collapse on Monday, you know, was that a brief blip, and now we're back on the upside, and that was all temporary and we can forget about it and just start buying stocks again, or are we now in the beginnings of something that's more significant? I would say the absolute single most important piece of information that will determine whether this sell-off has ended for now or whether this sell-off has only just begun, I would say the one single bit of information comes on Wednesday next week. And this is the US January CPI data. So it's definitely all about inflation. And we're going to get a read on January inflation next week. And we've had that wage growth data from last week that really kind of shocked on the upside and got this sell-off moving. And we now need further information, and that will come next week. So inflation data next week, absolutely. The world's biggest data release will be that US CPI print. Okay. So for now, we're kind of in a little bit of limbo, I would say. And that nervousness last night, maybe it's due to the debt ceiling, or let's just call it the budget agreement in Washington. Maybe people worried about debt levels and deficit levels increasing and what that might mean. Perhaps, I don't know, it's hard to say. Let me just bring up the US 10-year bond chart here. If I go to just a 60-minute, we had a 10-year auction yesterday evening, which in the end, I mean, I guess not surprisingly, we just continued this. Well, look, this is let me just step back. On Monday, bond prices exploded to the upside as equities plummeted, pure risk off, and so flow into safe havens. So this is prices up, yields back down. But as you can see, this has been almost all given back. If I just draw a line in here, that low point we had earlier on in the week, we're not far off it now. So bonds have almost all retraced the entire kind of rebound on Monday. Now this has implications, obviously, because one of the reasons why stocks sold off on Monday was because bond yields were so high. Well, prices going lower again. Well, this is bond yields almost back to their highest. So this perhaps was another reason maybe why the equity space had a bit of a wobble and a sell-off into the close last night. Perhaps it's because bonds, T-notes here broke below the overnight low and made new lows for the session, really driven by the auction perhaps. But I guess it's just a continuation of this theme that ultimately yields are climbing. We had a temporary respite earlier on in the week, but it looks like this yield climbing scenario wants to get back going, and that's a concern for equity traders. When you get it on a daily chart, it's way more in perspective. That violent bounce on Monday, almost all of it's been given back. 120.18, key price point for T-notes. Anything below that, and that's then yields higher and pushing ever closer to that 3% handle that people are freaking out about. So just keep your eye on bonds. Maybe that was why equities just had a negative dip into the close. Let's talk about, well, let's hit some of the headlines, and we'll come back and we'll talk about oil. Let's have a look at some of the stuff going on in the press. This morning, there's Brexit chat. I mean, when is there not? So these are some of the headlines we've got on the Brexit front. Theresa May plans instant split from some EU rules after Brexit. So of course this is Theresa May trying to pander to the hard Brexiteers within her party. She flip-flops about. She sometimes tries to pander to the soft Brexiteers or the Remainers, and of course she's got a very difficult job here trying to keep the party together, and indeed in doing so trying to keep her job. These are an interesting kind of report here in the FT talking about Brexit and how's it going to cost different sectors. Is there a situation where there's certain sectors that are going to be worse off because of Brexit? And we've got a table here. This is the FT doing this study, and they're saying these costs would include, these extra costs would include things like customs checks, paperwork, rules of origin checks, and of course the tariffs. Just looking down the list, services, which of course this economy that we're in is so dependent on. About 85% of the UK economy is services, about 25% is financial services, so that's the big one. We're looking at about a 5 to 10% increase in costs, although certain business services might see no cost change at all. Construction, of course, is all domestic, and so that's not going to get any direct impact from Brexit. It might get indirectly impacted, of course. If the UK economy goes into recession, then fine. Construction might not see their costs rise, but they're going to see demand collapse. So they're perhaps not directly, but they're definitely indirectly exposed. But this was interesting. Like things like food and drink, particularly vulnerable. Agriculture, particularly vulnerable, apparently. Retail and wholesale, maybe as much as up to 20% increase in costs. So that was interesting just to see how the different sectors might get impacted. let's talk about oil then. So here are the headlines. Oil extends slide as record US output sparks supply glut fears. So this was the Department of Energy inventory data, as normal on a Wednesday afternoon, reported yesterday. Here's the chart I was talking about and touched on earlier. So what you got here is a chart looking at US output. So that's the green line, and obviously it's been ramping higher in recent years. This is the shale production boom. What was so surprising yesterday, this kind of punch through 10 million barrels a day. Okay, really surprise uptick. That's the number of barrels being produced per day. That's US producers now producing more. The shale production process is really expensive, but now that the price of oil has ramped back up through $60 a barrel, this makes their more expensive extraction process now profitable, and so they've ramped up production. And so you're up through 10 million barrels a day, which is a record ever in some counts, or at least it's the highest production rate since 1970. This is being compared to Bloomberg OPEC crude oil production output data. It's actually just looking at Saudi Arabia, because, as I said, this chart's a little bit misleading, implying that the US now produces more than OPEC, which is definitely not the case. It produces now more than Saudi Arabia, who is OPEC's biggest producer. So you've got US above Saudi. Look, this chart goes back, and the last time that happened, the last time the US produced more than Saudi Arabia was back in the 1980s, where we had the kind of oil crisis. So this is almost unheard of in recent decades, and perhaps just signifies that kind of game changer with regards to who's in control of price, and OPEC have lost control. But if I show you the oil chart to kind of bring this in perspective, what happened yesterday, what's been going on in recent months for oil, and what's going to happen next. So this is what happened yesterday, big sell-off. So off the back of this OPEC, US Department of Energy data showing a big build, but much more importantly, in my view, that production rate smashing up through 10 million barrels a day. You got some big downside. We took out what was the low of the day at 62.86. We then broke the, we broke everything, broke the 62 handle and plummeted and down to 61.25. Now it's a big downside here. Let's get this in perspective though, because we've had some big upside in recent weeks stroke months. So the price of oil launched higher at the end of last year, broke up through the $60 handle, broke up through the November high at $59, and really ramped aggressively higher. Okay, this was to do with dollar weakness, number one, and perhaps more than that, a real step up in global GDP growth expectations. And so the faster economies grow, the more demands there is for oil, the more demands, the price gets forced up. So this was a very positive global growth demand side rally with some dollar weakness to help out. Okay, now then, this step lower here is quite significant. This yesterday sell-off, because we broke through the mid-January low, which really puts an end to this trend. This trend's done now. This is definitely a bearish trend reversal move yesterday. So that's key, right? But the important thing is, well, what happens now to price? And I think that ultimately, sorry, we're just getting a little bit of a fire alarm test here. I'm going to persevere despite that noise interruption. So the important question is, where do we go now? And as you can see so far today, this tiny little red candle that we've got down here, we're just consolidating yesterday's sell-off, and we're just sat just above yesterday's low. So 61.25, very important price. The low point we had on the 5th of January was, let me just get that for you, 61.09. So any break below that, and I see a clean move to 60 and then $59. 59's key. That was the November high. So I think with a bit of dollar strength that we've got going, and we do have dollar strength, I'll show you those charts in a minute, and with US production all of a sudden ramping aggressively through 10 million barrels, I now see this market continuing to move lower, and I expect $59 by the end of this week or the start or midpoint of next week, let's say. All right, so pretty much a definite trend reversal here for crude, I would say, personally. Let's get back to some of these headlines. What else is happening? This is talking about the stock markets, and stocks tend to gain in the first week after a crash and then dip again and then resume the rally. This is, how many days after the crash and what's the stock market return. What we tend to see is 2 days after, which is pretty much where we are now, we tend to get a bounce. And then 5 days after, we tend to see that bounce increase, and then things pull back again. We're talking like 2 weeks after the crash, and then you get more of a longer term sustained push. Okay, this is looking at averages back to 1928. But I would say, I think it's a bit, I don't know, that VIX move that we had was so aggressive, but that was for its own reasons in some way. I think the correction was, obviously you're getting people talking about, let me just get the S&P chart up whilst I just mention this again. Correction, it's a healthy and needed correction, which is true. The stock market had been going up just in a straight line for 18 months. It needed a pullback. And some people say pullbacks are healthy and all the rest of it, but yeah, fine. Very important, what's going to happen next? And I think at the moment, you can't make the judgment of whether this is the beginning of something bigger on the downside. I think that story perhaps isn't, I think it's too soon for that. I think we'll get a big downside on equities, but not until second half of this year, maybe even start of next year. And it'll be that kind of debt, global debt risk with now elevated yields and borrowing costs that would lead to that. I think we're too early for that unless we get more news flow to set the alarm bells off again. And that will come, I think, if it's going to come, it needs to be US inflation related for one. And so we've got to wait until the middle of next week. I think January inflation next week will tell us whether we need to sell off more or whether the S&P is going to get back on the upside. Okay, soft inflation data next week, stocks will rally. Higher than expected inflation data next week, and I think we're perhaps going to get back down towards the lows, and who knows, maybe lower. It will depend on that US 10-year and what it does with the 3% handle. So that's the story for next week. Let's talk about this week. Let's talk about now. So here's a graphic, really good one. This is talking about the Bank of England this afternoon. So you know how this works. Midday, the Bank of England will release their decision as to whether they're going to change interest rates or not. And the answer to that I can tell you right now is they're not going to change rates. Now, they hiked rates, remember, back in November last year. They hiked up one tick, so up to 0.5%. And really all we're concerned about today is what are they going to do with their forecasts on inflation and growth. And there's rumours out there that the Bank of England are going to upgrade their GDP forecast. Okay, that's the rumour, which I think is hilarious, because the Bank of England are notorious for being pessimistic with growth forecasts when the growth trajectory is really positive. So they always undercook it and get it wrong and underestimate growth when growth's good. And then the irony is beautiful. When growth really starts to look vulnerable and we've got negative growth outlooks, this is when the Bank of England come in and start getting positive. It's almost like they've got the worst GDP growth forecast engine in the world. It's like a reverse indicator. So I think it would be so ironic for me today if they stepped in and upgraded their growth forecast, because pretty much everyone else is thinking the exact opposite. Anyway, that might be key as to what they do. Now, the most important thing here is, yes, what do they do with their growth forecast and their inflation forecast, but the key will be the vote count. And we're going to get this at 12 o'clock. So look on the left-hand column. This is the vote split. There's 9 members on the voting committee. And will they vote? How will they vote? So one option is 9-0. So that would be, and that's consensus, all right? ING here, this is ING's graphic. They are not consensus. They're hawkish. I'll talk about that in a second. Most people are thinking 9-0. That means that all 9 members think it's appropriate to keep rates on hold, okay? ING are going for 7-2. This would be very hawkish if this happens. They reckon that 2 members of the committee will vote to hike rates today. Now, let me show you a spreadsheet. Let's get a bit geeky on this. So this spreadsheet is looking at the dates of each meeting going back over the last couple of years. It's looking at the interest rate decision at that meeting. And then it's looking at the voters and how they voted. Look at the top, I've got all the names of the members of the committee. Okay, so in November, let me highlight that column. They voted to hike rates. Well, who voted to hike? Broadbent, Carney. The dissenters, that's those that voted for no hike, were Cunliffe. So these are the doves in the committee. Haldane, McCafferty voted to hike. Ramsden voted to keep rates on hold. Saunders voted to hike. And you can see, right, most voted to hike, apart from 2 of them. Now, the meeting in December, everyone reverted back to no hike. Okay? Now, what ING thinks is going to happen today, we've got 2 hawks in this committee, McCafferty and Saunders. You can see they've got a history here of voting for hikes, you know, right the way through Q3 and into that actual hike in November. They were voting for hikes for 4 meetings in a row until they finally got their way. McCafferty, he goes back, look, 2015 and 16, he was voting for hikes all through this period when no one else was. Okay, so there is a chance you might get McCafferty and Saunders with an uptick in GDP forecast. They might start saying, well, let's start hiking. And so you might get a 7-2, okay? Now, personally, I wouldn't, well, if I was on the committee, I'd vote for no hike. What are they looking at? Well, look, here's the inflation situation, and it's still too high. Inflation's still at 3%. We need inflation at 2%, not 3%. This is creating real challenges for and real economic growth headwinds, because wage growth is down around 2% and inflation's at 3%, meaning we're getting poorer. The cost of living is getting more expensive at a faster rate than our wages are going up. Bad news for growth. So there is an argument here to say hike rates to try and get inflation back down. But then you've got a real risk there, because if you hike rates, borrowing costs get more expensive, and that might dampen growth even more and create the recession that they're trying to avoid. So they've got a real problem here, the Bank of England. The one key reason why inflation's so high, though, is because the value of the pound collapsed after the Brexit vote. So what's been going on with the value of the pound? And should we be thinking about how's that going to affect inflation, let's say, through the summer? And let me show you a daily chart for the pound. And look how high it is. All right, in the last week, we've come sharply lower. I'll talk about that in a minute. But looking over the last few months, we've come really high. So this is sterling appreciating. If you're looking at an annualized basis, where's the value of the pound now compared to a year ago? It's a hell of a lot higher. 1 year ago, let's say start of February, we were trading at 124. We're now at 139. That's a huge increase. That's sterling appreciation, which should in time feed through negatively to inflation. If I was on the Bank of England committee, given the Brexit growth headwinds and the uncertainties and the weak economic data we're getting, I'd be saying, well, we don't need to hike rates because the uptick in the pound's value will naturally bring inflation back down for us over the medium term. So I wouldn't be getting anywhere near hiking. So I'm expecting 9-0 today if it's 7-2. If ING are right, well then this sell-off we've had in the pound over the last week, well that is we're gonna get a serious bid tone. We're down around these important couple of price points. So we're testing the low from yesterday at the moment, and then you got the low from the day before, 138.57. Okay, if it's 7-2, then you're going to get sterling ramping back up through the 140 handle. Okay, 140 is really important. 7-2, cable back above 140. 9-0, and I think this downtrend can continue, given the strong dollar and given the kind of Brexit risks that are bubbling away. Okay, so really important event, most important event of the day, comes around midday. Mark Carney's press conference will then begin at 12:30. Okay, right, just to kind of wrap up, I'm not going to go on. I'll talk about some of this other stuff later on this morning. We've got some chat from the Bank of Japan. I'll talk about that stuff later. It's not that critical to what we're looking at. I need to talk about the US budget deal. I'll perhaps cover that off later on in the day, but just to say they've done a deal on paper. That's just the Senate bipartisan committee. This has not been voted through the Senate. That's expected to happen today, and we expect it to get through the Senate. The real challenge will be getting through the House of Representatives. It's quite a contentious deal, this, because it does allow the government to ramp up borrowing. They're looking to spend in the tune of $700 billion this year and then $716 billion next year. They're looking to ramp up spending on the military, on things like the infrastructure. So that's on the one hand. This is a very democratic policy. The Democrats are loving this. So that's very democratic. That's why we're thinking it might be tough to get this through the House, which has got a much larger Republican majority. The other half of the bill is talking about immigration and talking about children, the dreamers, as they're being called. And this is more of the Republican side of it, because they're blocking these immigrant children from getting residency. That's the Republicans are, but the Democrats would like them to get that. So it is a bipartisan deal, but it's quite contentious on both sides of that. And you've got reasons for Republicans to be really anti it, and you've got reasons for Democrats to be really anti it as well. So we're thinking, I would say it probably is not going to get through the House first time round, but we'll see. In the meantime, they've agreed to keep the government open until the end of March whilst they try and sort out a 2-year deal. Okay, but perhaps the big risk here is on the debt side, because if this gets through and US government borrowing ramps higher to pay for all of this extra spending, well then they've got problems on the debt side, because their debt to GDP ratio is already at 106%. This is looking over the last decade. Look over the last 90 years here, and this is not sustainable. You can't have this debt continuing to ride higher forever. I mean, at some point this has got to stop, and maybe this is where the next crisis comes from. It's global debt, because we've had a debt crisis already 10 years ago. And where's all the debt gone? Well, I can tell you it's gone nowhere. It's still in the system, and indeed it's got bigger. So you can't just see this debt ignored. So in the end, if these debt trajectories carry on going, which it looks like they will with this US budget deal, well, then in the end, isn't it just all going to blow up again in our face? I don't know, maybe, but that's probably a 2019 story. Right, on that happy note, let me just show you the data calendar, where, you know, ignore most things apart from the Bank of England. That's the big event. Loads of speakers on the central bank front as usual. We had some Fed guys talking yesterday and basically saying, forget the equity market sell-off is irrelevant to our thinking unless yields continue to move higher and stay elevated for a reasonable period of time, let's say months. Well then, okay, fine, that might create a drag on growth and we might have to take account of that. But at the moment, you know, a couple of days worth of downside on stocks, we don't care. That's what the Fed's message is. Right, I'm going to leave you guys to crack on with it. Definitely the Bank of England is the big event. Currently we've got cable testing yesterday's low, sat just above the low from the day before. We're off the back of a very strong move to the downside over the course of this week and the end of last week. Will those hawks, will McCafferty and Saunders vote for a hike and get the pound pushing back higher, or will they not? Will it be 9-0, in which case this downtrend is going to continue? All right, guys, enjoy the session.